Hello and welcome back to part two of the Nadex Pro Series. I'm Dan Cook, Director of Business Development here at Nadex. Very glad you could join me. Today we're going to be taking a look at the different products or contracts that Nadex offers. Binary option, call spread, and touch bracket contracts. We're going to dive into the meat and potatoes as far as how they're structured, how pricing works, and a few trade examples to really give you a good overview. Now after this, I definitely encourage, if you're new to Nadex, take a look at these contracts in the demo environment, start to trade them, understand how they work. A demo environment will never teach you how to trade, but it's very important in understanding how the platform works and how the contracts work. It'll help save a lot of mistakes that could otherwise be costly in the live market. Before we begin, speaking of costly, we need to understand our risk. Trading on Nadex or any other market that you put money up to place a trade involves financial risk. It is not suitable for everybody. It is not easy. Trust me, I've been doing this over 20 years. I've been placing trades, and it can be very difficult. Definitely want you to understand what you're doing before you hop into the live market, which is one of the reasons why we're happy you could join us here tonight. It's just the probability of success is so much greater with those that really take the time to study not only the platform and the products, but the markets and really understand their analysis and have a trading plan. And we're going to talk a little bit about just a little bit about trading plan as we're talking about the products here. Trading can be volatile, right? Very volatile. Binary options can move very fast. All markets can move really fast. Binaries just do it on a very frequent basis, particularly close to expiration, as I'm sure many of you have seen. Also, this presentation is wholly owned and subject to copyright by the North American Derivatives Exchange. We own it. Please don't record it or reproduce it, distribute it, or any of that other things. It's strictly prohibited. And it also just isn't cool. So with that, let's get into the products. So we're going to start out with binary options. We're going to take a look at the pricing functionality and some trade examples on binary options, touch brackets, and call spreads. So let's first take a look at binary option, right? If you're not familiar, a binary option is a pretty straightforward contract. It basically asks a simple question. Will a market be above this price at this time? In the example here, we can see the Wall Street 30. The question is, Wall Street 30, will it be greater than the level of 26,110 at 4:15? Now, this screenshot was done on the 10th of April. That was the expiration date for this particular contract. Just below that, we also see that it expires in 1 hour and 38 minutes. So we know kind of what time frame we're dealing with. Now, binary options also offer multiple time frames. You can trade them as short as 5 minutes on currencies and 20 minutes on futures indices, intraday 2 hours, daily, as well as weekly. So really, for any type of trading style, there's a binary option time frame that's suitable for you. Maybe you're more of a swing trader, which wants to stay in a trade for a day or two, or thinks the market will develop over that time frame. Maybe you really want to get in on the quick 5-minute binaries. They move very fast. You don't have to sit there and watch your screen all day. Some people, it's all your preference. And if you don't know what your preference is, definitely take some time in the demo environment and learn kind of what type of trader you are. That's why it's there. Use it as long as you need. So in the binary statement, Wall Street 30 greater than 26,110 at 4:15 p.m. Right? Currently, this binary option, we've got a bid of 67.50 and an offer of 74.75. Now, I'm going to make a couple key points about binary options because while I said they're a pretty straightforward contract and actually pretty simple to understand, right? There are a lot of things that are just often overlooked because of that perceived simplicity that may be beneficial to you as a trader, right? The first one, as you can see on this order ticket here, the price is $72. You don't just have to take what's being bid or offered. You can work a price. This is an exchange. So in this case, if we were to try to place this trade, now there's no guaranteed fill, I'm going to try to place this at $72. Get a little bit better buy price than that $74.75 offered, right? So if I think the answer to this question is going to be yes, I'm a buyer. If I think the answer is going to be no, I'm a seller. At expiration, that yes or no question is going to be answered, right? And at that point, it's all or nothing. At expiration, I'm either going to get $100 or I'm going to not get anything. The pricing is based on the probability, or the perceived probability is reflected in the market of whether that binary option will finish what we call in the money or greater than the price level. With a binary option, it has to finish greater than the strike level. The strike level in this case being greater than 26,110, right? So it has to be greater than that. If it's right on the strike or below, it settles what's called out of the money, or OTM, and expires worthless for the buyers, and the sellers would receive the $100, right? So the question is always, will it be greater than? One thing I want to point out, because we talked about all or nothing at expiration, and we talked a little bit about it in the first module in part 1 when we were looking at placing trades, you don't have to hold a binary option at expiration. Let's say, for instance, you bought a binary option at 30, right? And the market really moved in your favor, and you've got a couple hours left till expiration, but now you could close it out or sell it at, say, 96. The question is, do you want to risk the $66 per contract that you've already made, not including fees, on another 4, right? A lot of times people will choose to close those out. Now, it might be such a market circumstance where there's just a bid sitting out there and there's no offer and you feel comfortable with that. That's a trading decision, right? But know that it's a possibility. If you bought 10 contracts at 30, you can also set limit orders to close those out if the market goes in your favor. Say, set a limit order, and we looked at that in the first module. So if you haven't seen that one yet, you can go back and review that. You might set a limit order for 3 contracts at 60 and 3 at 70 and 3 at 80, and then maybe let the last of your 10 see if it goes to 100. So there's a lot of flexibility. So don't be misled by the all or nothing idea, right? If maybe you bought at 30 and it starts dropping to 20, you might make a trading decision at that point to cut your losses at 20 and not let it go to 0. So you have that flexibility. So when you're buying a binary option, right? When you're buying a binary option, whatever your price you're buying it at. So in this example, I'm trying to buy it at 72. I have $72 risk. That's my worst case scenario. It can never go below 0 and it can never go above 100, right? So if I'm a buyer, my risk is determined by where I buy to the floor. So if I buy at 30, I have $30 risk. My potential upside as a buyer is wherever I buy to 100. So in this case, the ceiling is 100, right? If I'm buying at 72, my maximum potential reward, not including fees, is $28, right? 100 minus 72. As a buyer, it's 100 minus wherever I buy. That is my maximum potential profit. A handy thing also, if you notice at the bottom of the order ticket, on all Nadex contracts, it will always tell you what your maximum loss is, as well as your maximum profit. For example, though, while I'm looking at my maximum loss of $72, if I buy at 72 and that order gets filled, and the market drops down and all of a sudden it's sitting at 50, right? I might want to try to close out if I can get out at 50 and prevent the maximum loss. Again, you have that flexibility. On the sell side, it's just the inverse, right? So on the sell side, if I sold at 72, right, I would have $28 maximum risk. It's the difference between where I sold and 100. So 100 minus my sell price, that's my maximum risk. My maximum potential profit, if I was selling at 72, right, would be 72 to the floor. So when I'm selling, it's wherever I'm selling to the point of 0. So if I'm selling at 30, my maximum potential profit is 30. This has been a quick overview of binary options. I don't want to bore you too much with them. We've got a lot of great information on the website. Really want to provide a high-level overview so you have a good understanding of the basic structure and how the pricing works. So let's get into touch brackets. So a touch bracket is the newest contract we have here at Nadex, and it's offered on stock index futures and currencies. These were the initial markets to launch. We're always looking at new contracts. We just really want to provide the best trading experience. Touch brackets are very unique for the industry. There is really nothing out there like them. And they offer a great way, whether you're a new trader to the markets and have never traded futures before, maybe you've tried futures and you just found that trading a huge contract was too much risk, this gives you an opportunity to get into the market. Maybe you're an experienced trader that just is looking to, add another weapon in your arsenal. That might be an alternative for you as well. A touch bracket is basically a range. So if we look at the order ticket, we see again the Wall Street 30, and the range is 2630 to 26530. That's the entire range of the contract, right? We see the bid offer. These track very linearly with the underlying market. That's how they're designed. When I'm buying a touch bracket, I look to the floor and ceiling. Now, again, on the order ticket, it'll tell you what your maximum risk, whether you're buying or selling, is, your maximum potential loss, or your maximum potential profit. And again, you can close these contracts out early. There's a couple of ways that they can expire, which we'll talk about in just a moment. But basically, the touch bracket range, if price touches the floor or the ceiling, that contract is automatically expired. So if I'm a buyer, the floor caps my maximum loss. If I buy and it hits the floor, so in this case, I bought at 26,130. If that gets filled, I have a $100 range on one contract to the floor. If the market drops and hits that level, that contract is expired and I realize my $100 loss. If, on the other hand, the market really skyrockets and hits the ceiling at 26,530, I have a $400 potential upside, not including fees. This does actually a couple of important things. I've been around the markets a long time. I've had the pleasure of working with literally thousands of traders over that tenure, some with all varying levels of experience. And one of the things that I found, one of the most common mistakes I see in traders is that they don't have they don't have an overall trading plan, but that's a whole nother topic for another day. But they don't plan out each trade. Right? So I see them in the currency markets, whereas I spent a lot of time trading over the years in the underlying markets. And one of the things as a trading coach I would see is that people would get into a trade and they might even put a stop order out there. And then the market starts moving against them and they start moving the stop farther and farther away because they want to be right? They lack some discipline, or they have a mental stop, which is awful because that's just almost a sure loss because it'll never go. And we talk a lot about that, and I'm sure you've seen tons of trading education on that and on managing risk. And thankfully, this contract does that for you. You know your maximum loss. There's no slippage like a stop in the traditional market. So even if there's a big market event or maybe there's a market gap, there's no slippage. That's basically a contractual stop at 2630 on this contract if you're a buyer. Now, another big mistake that I've talked a lot about over the years is not taking profit, right? It might not be as bad as moving your stop or not having a stop if you're trading the underlying market, but it's right up there, right? Because if you don't ever take profit, the market will eventually turn, and if you didn't take any money, it'll go against you, and then you'll lose money. So that's another key mistake. This contract, by its very structure, right? That's not a possibility. Now, you can set another limit order on this to take profit. So, for example, if you bought at 26,130, maybe if the market goes to 26,230, you could set a limit order to take profit. So it's not getting out of having a plan. You still need to have a plan. Even here at Nadex, you need to have a plan for every trade, right? So if the market, though, does really rally and hits that ceiling, right, those are about the times when, a lot of newer traders, particularly, will think it's going to just rally forever, and then they never take it, and the market moves really fast, and all of a sudden it drops as fast as it rose. And then with the volatility that we've seen here pretty lately, that's a definite possibility. So this really gives a trading plan or a plan for each trade, because you know going in what your maximum potential profit is, you know what your maximum potential loss is, and you can't move those boundaries once you're in a trade, right? So it's almost discipline by design, right? Which is a pretty cool thing. It has a strategy built in. These contracts are all a maximum duration of 1 week. Look at the contract specs and you'll be able to tell the size, but also it's pretty easy if you want to know what the total value of a contract is. If you put in a one lot in the size, you'll be able to see your max loss and your max profit. The combination of those is the full contract value, right? If a bracket gets hit, and we'll talk about that because we've seen that, if a bracket does get hit, a new one will be generated in order to replace the previous one. The idea behind these brackets is whether you're a buyer or a seller, right? If you're a seller, your maximum risk is between where you sell and the ceiling, maximum potential profit from where you sell to the floor, right? But the whole idea behind the touch brackets, how they were designed, was so that whether you're long or short, there's going to be an opportunity where you can get in at a lower cost, fully defined risk, have good potential upside, right? And you can basically benefit from the effectiveness of leverage without having to worry about, a severe market move creating losses beyond what you ever expected. You know up front what your maximum loss is. And these are only offered by Nadex. So let's real quick take a look at the at kind of how the brackets are structured. So this is the beginning of the week, right? We're going to list 4 different brackets, and you can see on this stair-step formation, right? We'll call them brackets 1, 2, 3, 4. In this case, if you were looking to get long, your lowest cost contract, so if you're looking to be a buyer, if you think the market's going to go up, your lowest cost contract is number 1, right? It's got the area closest to the floor, right? That's where the underlying market sits closest to the floor. That's going to be the lowest cost if you're a buyer. Now, that said, don't just automatically choose the bracket that's closest. If the market's only a couple of ticks away and you're expecting this to be a little bit longer type of time frame, you may want to take on a little bit more risk, give up a little bit of that upside potential, but also give the market a little bit of room to breathe. Now, if you want to be a seller, you may look first to contract number 4. And these are listed out on the platform, right? Contract number 4, the ceiling is closest to the underlying price. And if you want to be a seller, you might want to look at contract number 4. Again, if it's too close to the ceiling, you may want to, make a trading decision and say, hey, I want a little bit more room to breathe. I might choose the one that's got a little bit more room, giving me a little bit more flexibility in case it goes a little bit more against me. I don't want to get, knocked out right away. If, for example, let's say number 1 contract was knocked out, there would be another contract, we'll call it number 5, that would go just to the right of contract number 4 in that stair-step fashion, right? It goes down in a stair-step as the market drops and they get knocked out. It goes up in a stair-step fashion as the market goes up and contracts get knocked out. This has been a brief overview of the touch bracket functionality. I hope it's been helpful. And now we'll hop into call spreads. So call spread functionality, and I think call spreads are great contracts. They're probably a little bit more difficult, I would say, to learn. I've often heard it said that they're a little bit harder to learn, but easier to master. And I think because there's a little bit of an upfront learning curve, but then once you get it, you really understand them. And this is really a contract that introduces optionality. So if you've ever wanted to learn options, but have been scared to really, this is a great way to get dip your feet into the options pool. And the reason I say that is it basically takes a simple option strategy called a call spread and simplifies it by packaging it as a single unit. And I won't go too much into options, except real quick to share my own story of options. I think are great contracts, but about 15 years ago when I really started getting into them, I learned the basics pretty quickly. Then all of a sudden we started getting into the Greeks. And then they started talking about pricing models. And then people were throwing out, oh, you need this super complex 18-leg strategy. Don't know what that means. Don't worry about it because you really never need to know that. And it was really hard to keep it simple for very long. So this is a great way to start learning the key elements of options. One of those things being how volatility impacts it, time, and how the contract works with optionality. A call spread by its very structure, you may see, is very similar to the touch bracket. The big difference is on a call spread, because you pay basically a little bit, one of the great things about options is basically it's insurance, right? You pay a little bit of insurance up front. But if it falls to the floor or ceiling, you're not automatically knocked out of that contract. Your risk is still defined, but let's say I bought the contract. If it drops through the floor, it's not going to knock me out. I'm basically buying time to be right. Now, for that privilege, I may pay a little bit more in premium, right? So I may pay a little bit. So if I'm a buyer, the market may be, let's say right now we've got in the example 26,170. And when it's close to the floor, right, I'm getting very high effective leverage in that if it's close to the floor, I'm going to pay a little bit more premium because I'm buying a lot of protection. I've got a lot of upside. So perhaps the market, say, was at 26,165, right? that would be where the offer price was, or that's where the underlying indicative is, I might have to pay a little bit of premium. So maybe I pay the 26,170, but I do that because in case the market drops, I'm not getting knocked out at the floor. That's the biggest difference between the call spreads and the touch brackets. The touch brackets move in very much linearity with the underlying market and get knocked out on the ends. With a call spread, you pay a little bit of premium typically if you're near the floor or ceiling. But then you get that flexibility of if the market drops through that level, you're not out of the trade. You can still have time to be right. Again, though, the floor and ceiling are there to protect your downside and also define your potential profit potential. So, right, whether you're long or short, if you're long, the floor defends your risk. Again, though, you're not stopped out. The ceiling would be your maximum profit objective. Again, just like every other Nadex contract, you can close it out early. If you've got profit and you want to lock that in, you can lock it in. If you've got losses and you think you don't want to take any more, try to close that out. Get out of that losing trade. Right? If you're selling, the ceiling is protecting your basically your risk on the sell. The floor is your maximum potential profit. And so you can limit losses without getting stopped out. Key factor. So the call spreads, and this is another one when we're talking about touch brackets, right? Touch brackets can get knocked out, and that's one way they can expire. They can get knocked out during the week, or they can expire by time on Friday afternoon. Call spreads are the same way. They expire only by time. Remember, you're never knocked out. You can close the position early, but they'll only expire, whether it be an intraday or a daily spread contract, they'll only expire at the designated time and will be what's called a variable payout. Remember, we talked about all or nothing in binary options where it's 0 100 at expiration. In a call spread, if I bought at 26,170, and let's say at Friday, I'm trading on a Friday afternoon, the settlement value is at 26,270. Right? I made 100 points. That's where it expires. I would get the difference between my buy price and where it settles. Right? In that case, if it was 26,270, it would be 100 ticks or $100 less my exchange fees. It might also settle for loss. So it's basically wherever I buy or sell, and then wherever the underlying market expires if I let it go to expiration, right? So that could be for profit or for loss. And this has been a high-level overview of the Nadex products, binary options, touch brackets, and call spreads. Questions and feedback, give us a shout. There's our information. We basically got 24-hour client support from all the market hours that were open Sunday afternoon to Friday afternoon. Phone number, shoot us an email at customerservice@nadex.com. You can get a hold of your account specialists, 312-884-0162. Love to hear your questions, feedbacks on the webinar, particularly if it's something that we can do better or other content you'd like to see. We want you to help shape your trading experience and your education experience here at Nadex. So if there's something you need from an education standpoint, shoot us an email, asknadex@nadex.com. Follow us on Twitter, and our hashtag on Twitter is asknadex.com. Hope to see you back for part 3.